The process of executing a successful trade begins with analyzing the higher time frames and zooming into the lower details to identify trading opportunities. There are three types of time frames, each serving a specific purpose. Firstly, we have higher time frames, such as weekly and daily, which we use to determine the overall market direction and identify key levels. Secondly, we have analysis time frames, where we conduct most of our analysis, including applying concepts such as identifying market direction, fair value gaps, order blocks, liquidity areas, and potential trading opportunities. Finally, we have entry time frames of 15 minutes and 5 minutes, where we seek confirmations before entering the trade. As we begin our analysis on the 1-hour chart, our initial step is to outline the market structure's schematic to understand the market direction and structure. This schematic is sketched from the lowest point to the highest points of visible swings. For example, here this could be the schematics of market structure swings for this pair. Now, you can also draw some internal structures onto the chart as well. However, the primary objective of sketching a schematic is to observe the recent movements of bulls and bears in the line chart to get a clearer understanding of who is in control. Every reaction to a certain price level could be considered a swing. However, the strength of a price movement is determined by the distance it has pushed, the imbalance, and the rejections through wicks. Now, in order to make the schematic drawing non-subjective, we have specific rules for identifying the major swings, through which we obtain the general market direction via these levels. Let me walk you through how we identify these major swings. Here we see a sharp bearish movement establishing a low, which we mark on our schematic. To identify further swings, we wait for the price to break and close below the previous market structure. The peak point between these consecutive lows becomes our major high. Now, we can accurately draw the schematic. These lines represent the major swings, while anything between them constitutes internal structure. It's important to note that our trend identification primarily relies on these major swings. Following this, we wait for the price to either break the high to the upside or the lower low to the downside. Once again, the peak point between these consecutive lows becomes our major high. Next, we can see that the price has broken the swing high to the upside. This indicates a shift in the market structure, because the sellers have failed to hold this level, and now the buyers have taken control. So we have a new high. Subsequently, the price breaks this high to the upside. Therefore, the lowest point between these highs is considered our major low. As I mentioned, these are considered the major swings that our directional analysis relies on. Anything between them is considered the internal structure or minor swings, but sometimes they can also provide valuable trading information and opportunities. For example here, this marks the beginning of the latest bearish impulsive movement. However, the origin point of this imbalance is these candles. So, the supply order block is located here, and if the price returns to this level, it could offer a great trading opportunity. On the other hand, if the price manages to break above this extreme supply level, it indicates a significant loss in bearish momentum, which could signal a potential trend change. Here we have gold on the 4-hour chart. This is the latest market structure schematic. If we bring the schematic to the side, this market structure is exactly what we are looking for when we want to trade. A clear market structure, movements with obvious direction and swing points. Now, we can apply the smart money concepts to find opportunities to go long with the dominant bullish direction. Or, if the price breaks the latest swing low to the downside, we can take short entries until we reach the next important key demand area. On the contrary, look at this chart. This is the latest market structure schematic. The market is continuously validating the major swing highs and lows to both sides, leaving us with no clear direction. This is the time when we have to stay away from the market until we get a clear bias. Knowing when not to trade is as important as identifying the right time to execute one. Also, always pay attention to upcoming major news, because they will significantly impact the price without regard to technical situations. If you're curious about how we stay updated on financial news analysis, the initial step is to open the chart in the analysis time frame and sketch out the most recent market structure. So obviously we have a moving downtrend in the dollar-yen in 1-hour chart. The next step is to zoom out to the higher time frames such as weekly and daily to observe the larger scale. We do not want to complicate our trading. We only use the daily time frame to determine the overall market direction and identify key levels. We determine the overall market direction to see if our lower time frame analysis is aligned with the higher time frame bias or not. Secondly, we identify daily key levels to see how much room we have before price tapping into a key level of support or resistance. This also helps us to determine our higher time frame target. So, here on the daily time frame, what do we have in terms of price action? The market was in a long-term downtrend until it broke the trend line to the upside after rejecting this key area of support 3 times. We also have a change of character that shows the buyers have taken control and the price might start a counter trend. We can also witness that the price has recently rejected this area of resistance. Right now, we don't have a clear bias because this order block can cause a reversal. We have to wait for the next moves in the market. If the price breaks this supply area to the upside, it shows that the buyers have taken control, and we can go long until we reach the next supply zone in front of the price. On the contrary, if the price breaks below this demand zone, it shows that the sellers have taken control and we can look for short entries until the price reaches this demand area. As much as the higher timeframes are important, executing trades is done in the lower timeframes like 15 and 5 minutes. Combining the lower timeframes with the analysis timeframes is primarily for finding trading setups, entry reason, and confirmation. Usually, if we mark our trading zone in the 4-hour and 1-hour, we look for entering the market in the 15 minutes and 5 minutes respectively. Here on the Aussie dollar 1-hour time frame, the schematic of the latest swings does not show a visible trend. So let's see what we have in the 4-hour time frame. Here on the 4-hour chart, we can see a very smooth bearish trend if we draw all of the visible swings. Now, let's apply the smart money concepts to this chart. Here, we have a mitigated fair value gap area that pushed the price lower recently. If we focus, we can mark this major level of market structure that has acted as both support and resistance multiple times recently. So we have lots of liquidity above this area. We also have an unmitigated order block, which is a great supply area to look for short opportunities. But we cannot place trades at this order block, because first of all, this is a very large zone to place a trade. Second, the market shows a sign of indecision by failing to break this level to the downside. So a perfect idea would be to zoom into the lower time frame to look for confirmations to go short and enter the market at a better price. You could use various trading setups in the lower time frames, but as always, make sure to backtest your trading strategy enough to assess its performance and gain the required confidence to trade. Step. We use the TraderEdge platform for backtesting our exclusive trading strategies. If you're interested in using TraderEdge as your backtesting tool, be sure to check out the link in the description below. As we mentioned earlier, this is a 4-hour zone, so we need to zoom into the 15 minutes to execute the trade if we get the opportunity. Here on the 15 minutes, we have a double top reversal pattern rejecting this area. We have a drastic bearish move to the downside that created an imbalance. Now this is the confirmation that we were looking for. It shows that the sellers have entered the market and pushed the price lower, so it signals a possible reversal. But if we enter the market right now, our stop will be too large. So we need to wait for some sort of a pullback to enter at a better price. Even if we take the 4 bullish candles before the drastic move as our supply zone, we would still have a great risk-to-reward ratio trade. Our target is this demand area in front of the price, and our stop loss needs to be protected above this double top. If the price breaks and closes above the double top, this means that the seller has failed to push the price lower from the 4-hour supply zone, and we would close our trade with losses. So, let's see what will happen. Of course, this trade has happened in the past data, but the key point here is that even if it ended up losing still, it was a great trade, since we have combined multiple price action signals like the pieces of a puzzle to determine the next movements of the market. We identified that the higher time frame direction is bearish. We marked our supply zone and waited for the price to enter it. We waited for the price to show a bearish momentum and executed the trade based on measuring risk to reward. Here on the Dow Jones 1-hour time frame, we observe a bullish trend. The market continuously forms higher highs and higher lows. But where can we enter the bullish trend? As smart money traders, the first thing we look for is the fair value gap. By applying the Fibonacci retracement tool, we can observe that this fair value gap is precisely located between the 61.8% and 78.6% retracement levels. Therefore, if the price returns to this area, we can zoom into lower time frames to seek confirmation to enter a long position. So let's scale down to the 5-minute chart to observe the price action. Here on the 5-minute chart, we observe a very strong downtrend. The market has rejected the demand area with a double bottom reversal pattern, but we still have no entry reason to go long. We identify a fair value gap area and a robust supply zone ahead of the price, which could continue to drive the price downward. Therefore, the change of character occurs when the price breaks above the supply area. At this point, we can assert that supply is no longer in control, and the market may continue to move higher in line with the higher time frame. But how do we enter the market? We await the next moves to create a fair value gap and designate the candle that generated the imbalance as our demand area. We initiate a long position with a spread size above the order block and place our stop loss below the swing low. Let's observe the market's behavior. Here, the market has formed another order block. Without canceling the first trade, we open another long position, as the price could still return to this area and activate our order. However, it's important to note that this means the second trade may end up in a loss. Let's monitor the situation. This time, the second trade has been executed and resulted in a winning outcome. Remember, it's vital to understand the significance of risk management in trading. One key principle is to limit the amount of capital you risk on any single trade to around 2–3%. This means that even if a trade goes against you, it won't severely impact your overall account balance. By adhering to this rule, you're protecting yourself from significant losses that could jeopardize your trading capital. Remember, the goal is not just to make profits, but also to preserve and grow your capital over the long term. Consistently risking only a small portion of your capital ensures that you have the opportunity to recover from losses and continue trading with confidence. Ultimately, practicing effective risk management is a fundamental aspect of achieving success in the financial markets. So guys, that's it for this video. I hope this video provided value to you. If it did, please go ahead and smash the like button to show your support. And if you're new here, consider subscribing to our channel. See you in the next episode.